It's great to be able to introduce Kris Pedersen, who was here last year and came down and spoke, and very popular. And he's the only person I see turns up at the airport in the middle of winter in shorts, jandals and t-shirts, as he did last year. I thought, he must be mad. And he's done it again. But he had a little bit of, he had the shorts on, but he had a jacket on this time. So, but anyway, thanks guys, and please give a big hand for Kris Pedersen. He'll be able to introduce himself.
Thank you, David. Everyone can hear me okay? A bit of an intro on myself and my background. My story goes back to university. At that stage I wasn't really achieving too much. I was spending most of my time at the student pub and racking up a pretty decent student loan. I was a bit lost in regards to what I wanted to do. And a friend of mine dragged me along to a property seminar, a guy called Brad Sugars. Anyone in the room who did Brad Sugars before? Yeah. And that actually resonated with me at the time. I'm a bit of a numbers person, and so I suddenly started learning ferociously about property, went to every seminar I could go to, read every book I could read, and bent every ear there that I was able to. And it was a bit of a different world than probably kind of what we live in now, but I learned kind of very quickly that my parents were really willing to invest, to back my property investment career at the age of 20. And I wasn't that good at winning lotto, so I realised that finance probably was the missing piece of the puzzle. And the rules were quite different to now when I got back in, so there were some quite creative ways of getting into financing. And so I realised I was going to have to find some way kind of around the rules, and so a couple of examples of the stuff that we used to be able to do back then. This is a photo of shortly before we sold it, but in I think it was the early 2000s, we managed to find a funder who was happy to lend 80% against valuation. And for those of you who don't know, lenders these days will lend on the lower of purchase price or valuation. So we managed to find a property in Auckland for 221k. Sounds crazy hearing a Auckland property starting with a 2. And it valued up at 275,000. And as I said before, this lender was happy to lend 80% of the valuation. So for those of you equipped with numbers, I had to put a total of $1,000 into the deal. And promptly appointed myself as a rock star of investing. I thought this investing thing was easy. And then about 3 weeks later, I found out that my due diligence was horrendous, and there was about $65,000 of repairs that was required on the property. Good financing, horrible due diligence. So make sure you get a good team around you. I'm sure Els will talk about that kind of stuff as well. Learned over time other creative ways of investing. In the middle of the GFC, no bank was going to give me money, but we still wanted to basically kind of keep moving forward, and so we managed to negotiate with a vendor to effectively 100% vendor finance us into this property here. And in the way that we actually put it together, we managed to actually access the equivalent of an interest rate 2.5% below kind of what bank rates were at that time. And there's ways to do that kind of negotiating now. I won't get into it right at the moment, but there's particular ways you can do it in a high interest rate environment. So still investing now, invest alongside my wife, and we've also got a joint venture partner who's he's very good at finding deals. Managed to find this beauty. And I think also we'll talk as well in regards to how you've got to find deals and twist them around to kind of improve both the equity and the cash flow. So the inside looks a little bit better now. This is the downstairs, and that's one income, and this is basically the upstairs. And we've also got the ability to subdivide a section on which side we will basically build or sell that off. And I suppose besides my investing, if we go back a little bit, I started off in corporate. And my experience in corporate was a little bit like this. Don't know if there's anyone ever felt like this in a corporate career before. There might be a couple of you who maybe kind of experienced this. So I realised very quickly that the corporate world wasn't for me, and so I kind of went from quite a large corporate base into a small non-bank mortgage lender, fantastic education, and then basically set up my mortgage broking business in 2007. Now we specialise in investors and traders and developers. Looking back, setting up a investor-based mortgage broking business in 2007 wasn't the brightest idea, because a year after we had something called the global financial crisis, and no one wanted to lend any money. But we managed to survive for the last 17 years and learned a fair bit over that time. Managed to become kind of good mates with David. We also ran a property management business for a while that we sold in the middle of COVID. Feature a few pages actually along from David in the New Zealand Property Investor Mag on a monthly basis, and I tend to write the interest rate advice column. And I suppose where I'm going to start off, talking briefly about tonight is property cycle, and there's a number of variants on this. But I suppose what we tend to see is at the moment we've got a media which is beating up the property market in a lot of ways, with a lot of people freaking out thinking that it's not a good time to buy. But when you've been through a previous cycle, you can see some of the signs kind of going around again. And just to get a bit of an indication kind of where people think we're at, looking at the 4 quadrants in the middle, I'm just interested to kind of see where people think that we are kind of roughly at the moment. So does anyone think we're in the boom cycle? Just thankfully no one put their hand up there, I would have been a little bit worried. How about the slowdown part of the cycle? Okay. The slump? A few more hands? Okay, that means there's hardly any hands that have gone up. Obviously everyone thinks we're in recovery. Is that right? No? Okay, there's not many hands going up, so maybe a lot of you are unsure. I personally think we're probably, if you looked at this as a clock, somewhere around that kind of 4 to 5 o'clock area. I think we're very much in the slump part of the cycle. Interest rates have, of course, started coming down. We're seeing a case where there's a lot of listings. I'm talking across the New Zealand market. I can't talk too much around Southland. We're seeing the opposite of what we saw in the middle of COVID, where you couldn't basically bribe a tradie to do any work for you. Right now, we're seeing tradies everywhere are screaming out for work. And so to me, we're kind of right in the cycle here at the moment, which is actually quite a good time to buy if you know what you're doing. Now, a couple of key things that I'll focus on here from a financing point of view, talking about kind of interest rates, where I see those going, and also in regards to credit and credit relaxing. And credit doesn't tend to relax generally further into the recovery process. Banks have traditionally been quite cautious and nervous, and so they tend to, at this stage of the cycle, be pretty difficult to deal with. However, on the back of the previous government, they've been over-regulated, and we're actually seeing the opposite at the moment. We're seeing banks who are wanting to lend, but they can't because of how heavily they've been regulated. So firstly, talking about interest rates. And the Reserve Bank, at the moment, their projections are saying they're not going to cut the official cash rate. So the official cash rate, every 6 weeks they get together and they decide what they're going to do on interest rates. The next review is tomorrow. And I can already basically tell you that they'll keep it at 5.5%, where it's been since this time last year. And they're saying they're not going to cut the cash rate until probably again this time next year. If we look at bank economists, they're saying that they think that it'll start to get cut anywhere between, some commentators are saying November this year, others are saying, agreeing with the Reserve Bank all the way through to mid next year. I'm thinking it's going to be November personally, and my pick is looking at some of the data and just looking at the amount of negativity and pain and job losses and general feeling that we've kind of got going on out there. I don't think basically they can wait another 12 months before they start cutting, because there's about an 18-month to 2-year effect from when they make a move to when it actually hits the economy. If they're going to wait another 12 months before they start cutting, you can imagine the state of the economy if it's going to be another 18 months to 2 years after that. I don't know if we'll have much of an economy left. Now, the real key is, I suppose, how inflation fares, and then also, I suppose, the rate that the unemployment rate continues to move up. So the key dates that I'm looking at, I suppose, over the remainder of the year, if we look at the inflation, key inflation updates, unemployment updates, and the official cash rates. As I said, we've got the official cash rates happening every 6 weeks, but the other key reports are coming out on a quarterly basis. So while we've got an official cash rate coming out tomorrow, there'll be a bit of noise there, but it'll be kept the same. I can almost guarantee the next review will be kept at 5.5%. What the Reserve Bank is looking at is how inflation's tracking for the current quarter, and basically they will get those numbers coming through on the 17th of July. A couple of weeks after that, they're going to get the updated unemployment numbers. And if we look at the previous quarter, I think off the top of my head, it was about 38,000 people lost their jobs. I think that number's going to go up quite a bit at the next review on the 7th of August. A lot of pain is still going on out there. So I'm expecting in the media to start hearing quite a bit of noise from interested parties saying they should be cutting the rate on the 14th of August. And in some ways, as much as I agree, I don't think it'll happen. I think the Reserve Bank's still going to want to wait. They're going to be looking, I think, forward to later on the year in November, which is when they get the next kind of real proper set of this data. Basically waiting for the updated inflation numbers in October. And if you're looking at these numbers here, what they're focusing on is the local inflation. They can't control basically how prices are moving up and down overseas. they're interested in basically, I suppose, are businesses here pumping up their employees' incomes? Are they having to push up basically the prices of what they sell, which of course then has flow-on effects to inflation inside New Zealand. So that we then, I suppose, these two key dates, I think by the time we hit November, we're going to probably have enough negative data coming through, unfortunately enough, too much job loss, they're probably going to have to start looking at kind of pulling interest rates down. Now, recommendations, I suppose, on the back of that, make sure that you don't fix too long. If you look at interest rates at the moment, probably the most competitive interest rates are in that 3-4 year period. The problem is if you fix for that, interest rates drop, you're then liable for big break fees. So in most cases, we're recommending people fix for around a 6-month period. Not in all cases, but at the moment fix short, so you can then ride rates down when they start coming down. Now be willing to look elsewhere if you're coming out basically for your fixed rates. A lot of people have tended naturally to be quite loyal to their banks for years, but be aware that banks aren't that loyal to you. So at the moment, it's quite a good time to go shopping because what banks are being quite aggressive in how they're pricing. And don't look just at the interest rate if you're looking around, also look at cash contributions. Anyone in the room not know what I'm talking about with cash contributions? Okay, a couple of hands. So cash contributions are a bribe. Okay, so they're effectively a bribe given by a new bank to entice you to basically bring your business over to them. If you move basically a security over to them and take some debt over, they'll throw some cash at you. So at the moment with the banks, as an example, this is rough numbers, if you gave them $1 million of debt, they're going to give you anywhere between say $7,000 and $10,000 of cash for bringing that debt over to them. So this is one of we've seen some cases where clients are sitting there going, well, my bank's not giving me anything, I can go from bank A to bank B, take the cash, and in a lot of cases get a better rate. So the next point I want to talk about tonight is the availability of credit. And as I mentioned earlier, normally at this stage of the cycle, everyone's moaning about how difficult the banks are to deal with. And in a lot of cases they are. We're finding a lot of clients can't get through the affordability side of things. But to be fair to the banks, they're actually wanting to lend more. It goes back to what I said previously, they're being very heavily regulated. We're starting to see little tweaks though where banks are trying to improve criteria. So just a few little quick snapshots what I've seen this year. BNZ has introduced a 95% first home product. I've not seen a 95% product outside a government-backed product in over 10 years. TSB released a 10-year interest-only product. Some of you in the room will probably be aware that interest-only has become harder to get in recent years. Kiwibank is aggressively going after the market. So if you look at the whole New Zealand mortgage market, Kiwibank's got 7 to 8% of it. In the last 6 to 9 months, they've wrote about 25% of all mortgages. So they're out there writing a lot of business. They want it to be in the market. ASB, if you got debt with ASB last year and you tried to get a good rate, you probably found them very difficult to deal with. They were out of the market, really difficult. They've come back in because they lost a lot of market share right now. And then outside, looking at the non-bank market, these are the types of lenders who will do the mortgages outside the banks. They are trying to do a lot of product innovation at the moment. And we do a fair bit of development finance in the normal market. But at the moment, of course, interest rates are so high, most developers can't make projects work. So that market is awash with cash. If you go back to previous recessions, there's normally no development money around. At the moment, there's a lot of money, but in most cases, it's not feasible to use it because it's too expensive. So if we look at credit relaxing, we've got a government who is in a coalition who's looking at removing regulation. David Seymour appointed himself, I suppose, as Minister of Regulation, and what he really means is Minister of Deregulation. He's trying to remove as much red tape as possible. We've seen a case where there's been an investigation into the triple CFA, and so for those of you who don't know what I mean there, this was a change put in about 2.5 years ago by Labor, which turned the lights out on the ability to get finance overnight. Some of you might remember articles in the paper where the banks were forensically going through your bank statements line by line before being willing to give you a mortgage. So there's an investigation into that to try and make that process a whole lot easier. But there is a big elephant in the room. And before Grant Robertson departed, he decided to give the Reserve Bank a new tool, which is basically called debt to incomes. And it's worth having a bit of a chat over that so you kind of have a proper understanding on how that is looking at the moment, because at the moment it's at proposal stage. So owner-occupied lending is going to be restricted to 6 times household income. Have it outside that, the bank's going to be able to do 20% of lending outside that threshold. If we look at investment lending, they're going to be able to do 7 times household lending. Again, they're going to be able to do 20% further outside that 7 times threshold. So as an example, if you've got a 100,000 household income, what we're looking at is that basically mean that you can then get a $700,000 investment loan. That would then translate into a $600,000 owner-occupied loan. So what they're doing is they're using your gross income, not your net taxable income in your house. But when they look at what rental income you've got, they are going to actually scale it. So gross earned income plus scaled rental income is going to be the figure they're going to use to figure out these DTI equations behind the scenes. Now, I won't get into this too much now, but there are some exemptions. If you want to have a chat in regards to any of those, happy to talk afterwards or at a later date. But I want to give you a bit of an example so you can see right now, while debt to incomes won't have much of an effect on you as of today, and I think that's part of the reason the Reserve Bank wants to get it rammed through now so it doesn't really kind of cause too much media and political interference, but why I think it may have an effect on you in a year or two's time. So if we look at Joe and Mary, their situation is they've got a 110k combined household income. They own their own home with no mortgage on it. They've got a couple of rental properties with $1 million of debt, and they're receiving $1,000 per week in rent. Now, this is basically how banks would run an affordability calculator as of today. This is, there's variance on this from bank to bank, but this is a rough formula. So what they're doing is they're putting the numbers into a monthly basis. We're looking at Joe and Mary's net monthly income. We're looking at the monthly scaled rental income. You'll note there's an asterisk next to the rent scaling up there, and that's because banks are changing their numbers around a bit on what they'll take at the moment. But if we total up the income they'll take on a monthly basis, we've got $11,273 per month. Then on the expenses side, they strip out living expenses. You'll notice down here on the $1 million mortgage, they're going to assess them at a much higher interest rate than what they're paying. So at the moment, Joe and Mary might be paying 5%, they might be paying 4%, they might be paying 6%. Banks are assessing people on an interest rate of around 9% at the moment. Joe and Mary might be paying interest only on their mortgage. They're going to have all their debt assessed on a principal and interest basis. So it doesn't matter how your cash flow looks, they put all of your debt through on a formula like that at the moment. So Joe and Mary's situation, as of today, they've got $11,300 income coming in. They've got about $11,600 expenses according to the bank going out, so they can't borrow a dollar. So if we then basically look at how the new debt to income rules will follow through, we take their gross annual income, we take the scaled rental income, we add that together and we've got about $156,000. And as I said before, if we're looking at investment lending, we times that by 7. So then we've got kind of roughly $1,090,000. Now, can anyone remember how much debt they've actually got? No, how much? So they've got $1 million debt today, okay? So with debt to incomes, they can actually borrow more today under a debt to income than what the bank would allow them to get under their normal formula. Does that make sense? So far, debt to incomes don't look too bad, do they? This is looking okay. But this is looking okay because we're in a high interest rate environment. So if we look at basically how interest rates have played out over the last few years, the pink and blue lines are the 1 and 2 year rate over the last 5 or 6 years. And those dots all over the screen, these are the test rates that banks have used. So before, when I used the 9% assessment rate, these are the different test rates from banks over the last 5 or 6 years. If you look to the top right-hand side of the screen, you'll see as interest rates have trended up, the test rates have moved up. As interest rates should move down in the future, the test rates will move down. So what I expect to happen in the future is something like this. If we look at Joe and Mary in the future, hopefully they've had a bit of a pay rise. They're now up to say $120,000. They still own their own home with no mortgage on it. They had their $1 million on interest only, so it's still the same size, and they've used a great property manager, so they've had a bump in their rent up to $1,200 a week. So if we use the standard bank assessment, as I said, that's used now, we run it through, their total income is now around $12,600 a month. Note the other key factor is the test rates have dropped. So let's say test rates have now dropped down to say 6%. What we've now got is the 12,604 minus the total expenses of about 9,500 means they're sitting at a nice with a surplus. So rough numbers at the moment, that means that they could go out and they could probably borrow another 550,000 based on the standard formula that we've been using for a number of years now. That probably gets them into another rental property, if that makes sense. But let's now compare this though with how the debt to income looks basically in a lower interest rate environment. So we sit there and go, the gross annual income is 120k. We add on the scaled annual rental income. Keep in mind, as I said previously, with a little bit of bump in rental. And so the total annual income now is around that 175,000 figure. Times that by 7 and we're down to the 1.224 figure. So in the high interest rate market, if it made sense, the debt to incomes weren't looking too bad. As interest rates drop, the DTIs take over from how banks assess affordability and they're going to get restrictive. So in the current situation at the moment, if we move forward, interest rates dropped, they could basically borrow $500,000, maybe buy another property, but the DTIs are going to potentially stop investment, maybe over time. Now, a couple of graphs here that the Reserve Bank and ANZ have produced. What we're looking at on the left here is owner-occupied lending. What we're looking on the right is investment lending. And that little line that you can basically see there is the 20% threshold. If you remember on an earlier slide, one of the proposals is that the bank's going to be able to do 20% of their lending, 20% of their lending above 6 times for owner-occupied, 20% of their lending above 7 times for investment. Now, in the owner-occupied space, except for a little period through the peak of COVID, that's not going to have too much of an effect on the owner-occupied market. In the investor market, you can see quite clearly here that the last 18 months, property investors haven't been doing too much because the market's probably been pulling back. It's going to hit the investment market a lot harder. So a few final points in regards to DTIs. The final rules are not signed off yet. It's a proposal document. It was put forward mid-March. The New Zealand Banking Association and all the New Zealand Property Investment Associations have put proposals forward saying they want that exclusion to be increased to at least 30%. So to touch wood, that will basically happen. The implementation date, we're hearing this could be in place as early as July this year. So this is coming in potentially pretty quickly. The one positive, I suppose, in regards to that is that they are likely to relax the loan to value rules. So at the moment, if you have got second-hand property, you can only borrow up to 65% of it. They're looking to relax that you can borrow up to 70% of that property. So if you're a bit short on equity, you're going to be able to go a little bit further there. Now, also we'll talk basically shortly, but I think where you're going to want to be aware, especially when she starts talking about cash flow, is this might be an area that holds you back from investing, and so you're going to be wanting to look at properties which have the ability to increase cash flow. If you're hanging onto properties which are too negatively geared, you're going to be running into brick walls. So just a few quick recommendations before I pass it on. Review your current borrowing so you understand potentially how these new rules could affect you. Interest only, if you're reliant on interest only for being okay from a cash flow position, try and get that reviewed, in my opinion, in the next month or two, because if they put those rules in, they could become harder to roll your interest only terms over. If you're not sure how you look, talk to a local broker, talk to your banker, talk to us. We're happy to have a kind of a free chat so we can see how this basically looks for you. But if you need interest only from a cash flow point of view, and a lot of investors do, you're better to understand that now rather than getting a nasty surprise. And in regards to loan terms, in some cases what you'll be to do is extend the loan terms back out, because that improves the affordability in the eyes of the banks. And we also see a lot of investors who carry a lot of equity and they've given too much properties to one bank. In a lot of cases you can drop securities out and leave the bank with enough security coverage to move forward with. Happy to talk to more of you offline in regards to any of those points. So final kind of couple of points, especially in this market moving forward, be careful about having too much security with one bank. I've got an ebook, if anyone want to look at it, called The One Bank Trap. There's one of the country's top property accountants, Matthew Gilligan's also got a chapter in there where he explains carefully how to structure yourself properly. And as we're kind of in a recessionary market, I was going through some slides the other day and it actually, reminded me of a story of last time we were in a pretty harsh recession. And this is kind of an example of why you don't want to be caught in the one bank trap. And At that time I'd had two clients come and see me over the course of a couple of months who both bought into this disaster. So this was called Beaumont Quarter. It was the poster child for leasehold disasters in Auckland, and had been flogged off by some property spruikers. And effectively what happened is the average purchaser came in and they bought one of the apartments for about 450k. You only owned the building, you didn't own the land. And a couple of years after purchase, the ground rent went up about 400%. And these things plummeted in value to being worth about 80 to 100,000 each. So absolute disaster. Now, our first client came and saw me middle of the recession, self-employed, half a dozen properties with the one bank, and he asked what to do. And he'd gone in to see his banker. He told the banker, I'm going to sell off a couple of my properties. It's good for you, Mr. Banker, and it's good for me because I can get some of the surplus cash proceeds, put it in my back pocket and get through the recession. The banker said, we love the idea of you selling down properties, but we're taking any of those surplus cash proceeds. And they can do that because of how things are cross-secured behind the scenes. Client number two, the way he funded this is he borrowed 20% of the purchase price against his home. He then went to a second bank and he got the remaining 80% and offered the apartment up to them as security. When the ground lease went flying up and the property value went flying down, that bank who had lent him the majority of the funds started putting the squeeze on him and said, you need to improve our position because we're compromised here. So he came and saw me, we put him on to a lawyer, and he was able to go back to the bank and say, bugger off, I'm going to give you a couple of options. You can come after me, and the bank could theoretically look to mortgage him and bankrupt him, but keep in mind that they're so upside down that this guy was paying his mortgages, and so they decided to back off and leave him alone. Can you see how the first guy was compromised by structuring himself in the wrong way, and the second person was in a much better kind of position of power? So just make sure you set yourself up properly. That is me. I'll pass you on to Oops and be around for questions a bit later.